Hey, Jennifer Martin here with Affinity Real Properties Group at Keller Williams, North Atlanta, located here in Alpharetta, Georgia. What is PMI, private mortgage insurance, and when can it be removed from your loan? Well, if you put anything less than 20% down when you purchased your home, you most likely have what's called PMI, private mortgage insurance, which is a monthly amount that you're paying in addition to your mortgage. So I'm going to share my screen with you. Let's see here. Okay. Okay, so I just typed this up just so you can follow along. So let's say you bought your house last year in 2021 and you did 5% as a down payment. So at a $500,000 purchase price, your loan amount is $475. It's probably higher than this because the lender adds on fees, but 95% of 500,000 is going to be a loan for 475. Right? That's 5% down. So if you only put 5% down, you currently pay for private mortgage insurance. So in order to avoid paying for PMI, your best bet is to put 20% down when you buy and never have to pay the extra monthly fee. I mean, it's roughly around, 100 plus some odd dollars a month. I don't know the exact number. That's not the point we're talking about today anyways, but it is a monthly fee that is added. So the bank will only remove the PMI, the private mortgage insurance, once you have 20% equity in your home, meaning 80% loan to value, also known as LTV. So once you've been in your home for a year, and if you think you now have 20% equity, you can call your loan servicer, which is the lender that is shown on your mortgage statements, and tell them that you have 20% equity and you'd like to see if they will remove the mortgage insurance from your loan. So ways to get there faster, if you want to remove that PMI, and get to that 20% equity, the first thing is the obvious, which is to pay down your principal by making extra payments towards your principal in large chunks to get to that 20% equity, as soon as possible. The second way is to just wait for market values to increase. So recently, the market values have been increasing substantially. So year over year, if market values have increased 15%, you'll need to provide your lender with 3 recent sales that happened within the last 3 months to prove the new value of your home. So reach out to your local realtor. They can pull these sales. They're also called comps. The 3 sales should be in the same neighborhood or in the vicinity and close to the same square feet, close in bedroom bath count. And if the lender feels that the value has changed, they will most likely remove your PMI. The third way is lenders will typically automatically remove the PMI once your loan balance gets down to 80% LTV, loan to value. And this is based on the purchase price value. Okay, so when your lender automatically removes the private mortgage insurance, they're not running comps. They're not saying, well, what's the value today? And do they have 20% equity? No, it's a lot more. It's a simple calculation. They're just basing it off of how much have you paid on your loan. So once you pay down your loan enough where the loan is only 80% of your original purchase price, they will automatically remove it. So in a market that's climbing, you're definitely going to get there sooner. So by doing this, by taking the steps of pulling comps, reaching out to your lender, and getting them to remove this, you're able to remove this payment sooner than later. The fourth way is just by making substantial improvements to your home to increase the value. So let's say you bought your house last year and you did a complete renovation to your kitchen. It was dated and you updated it to 2022 styles. and you updated your bathrooms, maybe you put $35,000-$40,000 into your house. Now you've added a lot of value. So once you have those 3 recent sales to show the new value, your lender will consider removing the PMI. Now, if you just bought your house and you did renovations right away, here, I'm going to stop sharing so you can see me again. Okay, so if you just bought your house and you did renovations, say you put, I don't know, $40,000-$50,000 into it, you're not gonna be able to call your lender, 3 months after you bought your house and said, hey, can you remove my PMI? I just did, $50,000 worth of renovations. I now have 20% equity. They're probably not going to remove it. It hasn't been long enough. So typically, if you're going to try to get this done faster without waiting for them to automatically remove it, you need to wait 1 year. So if you bought your house last year, just mark it on your calendar for 1 year later. If you've made improvements, or maybe if market values have gone up, or you've paid down, a good chunk of your principal, 1 year later is a good time to reach out to your loan servicer to see if they can remove this PMI. And the cool thing about removing the PMI, if you're paying, I don't know, $120 a month, $150 a month, now instead of that going to private mortgage insurance, you can still make the same monthly payment and just apply that, 100 or 150 you're paying towards your principal, an extra money towards your principal just to pay off your house sooner, which is always fun. So anyways, I hope that was helpful, and have a wonderful day, and I'll talk to you later. Jennifer Martin, 470-258-5315.